Welcome to our channel. In this video, we explore the principles Warren Buffett follows to diversify his investment portfolio. Whether you are a beginner or an experienced investor, understanding Buffett's approach can help you maximize returns while minimizing risks. Diversification is a key concept in investing, and Buffett has always emphasized its importance. Contrary to common belief, he doesn't believe in over-diversifying. Instead, he focuses on investing in a handful of well-understood businesses that have strong fundamentals, long-term potential, and predictable cash flows. For Buffett, diversification isn't about owning hundreds of stocks just to spread risk. It's about choosing the right mix of high-quality investments that complement each other. He often says that investing in too many assets can dilute potential gains and make it harder to monitor performance effectively. Buffett also stresses understanding each company you invest in. This is sometimes called the circle of competence principle. By sticking to businesses you truly understand, you reduce the risk of making poor investment decisions. This approach allows him to diversify intelligently, rather than randomly. In addition to individual stocks, Buffett considers different industries and sectors. By investing in businesses that operate in different markets, he minimizes the impact of sector-specific downturns. For example, owning companies in consumer goods, financial services, and technology can balance overall portfolio risk. Another important aspect of Buffett's diversification strategy is time horizon. He prefers investments that he can hold for the long term, rather than constantly trading in and out of positions. This long-term mindset reduces the impact of short-term volatility and allows compound growth to work effectively across his portfolio. Buffett also looks at quality over quantity. A concentrated portfolio of exceptional companies can outperform a widely diversified portfolio of mediocre businesses. This requires careful research, patience, and discipline, qualities that Buffett has perfected over decades of investing. Finally, Buffett uses diversification as a tool for risk management, not for generating excitement or chasing trends. He avoids speculative investments and instead focuses on companies with consistent earnings, strong competitive advantages, and trustworthy management. This disciplined approach allows him to sleep peacefully at night while his money grows steadily over time. Warren Buffett's approach to diversification is not just about spreading your money across different stocks. It is about spreading your money intelligently. He once said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." This statement reveals the cornerstone of his philosophy. You don't need hundreds of stocks if you fully understand a handful of excellent companies. 1. Focus on high-quality businesses. Buffett invests in businesses with durable competitive advantages, often referred to as economic moats. These can include brand recognition, cost advantages, or a loyal customer base. By concentrating on these companies, he reduces risk because the underlying business can withstand market volatility. For instance, his investment in Coca-Cola and Apple demonstrates his preference for businesses that dominate their markets and generate consistent profits. 2. The circle of competence principle. One of Buffett's most repeated rules is to stay within your circle of competence. If you don't fully understand a business, you shouldn't invest in it. For diversification, this means he doesn't blindly buy stocks in sectors he knows nothing about. This careful selection allows him to focus on fewer but stronger positions. For example, he avoids cutting-edge technology startups he doesn't understand, preferring companies with a proven track record and predictable cash flow. 3. Sector and industry balance. While he focuses on a handful of businesses, Buffett ensures his investments cover different sectors to reduce risk. If one sector faces challenges, his investments in other sectors can offset potential losses. Historically, Buffett's portfolio has included consumer goods, banking, energy, and tech companies, creating a balance that benefits from multiple economic trends while insulating against sector-specific downturns. 4. Long-term perspective. Buffett's diversification strategy is deeply tied to his long-term investment horizon. Instead of frequently trading stocks to chase short-term gains, he prefers holding investments for decades. This long-term approach allows him to benefit from compound growth and reduces the risks associated with short-term market fluctuations. Investors trying to copy Buffett should remember that patience is as important as selection. 5. Risk management through concentration. While many believe diversification means owning dozens of stocks, Buffett shows that concentration can be safer if done wisely. By putting a larger portion of your portfolio into a few thoroughly researched companies, you increase potential gains while still managing risk. However, This approach requires discipline. You must avoid emotional decisions and stick to companies with strong fundamentals. 6. Learning from mistakes. Buffett has also spoken about mistakes in diversification. Early in his career, he learned that investing in companies you don't fully understand can destroy wealth, even if they appear diversified. This lesson reinforced his belief in fewer, high-conviction investments over a sprawling, unfocused portfolio. 7. Reinvestment strategy. Buffett doesn't just diversify across companies, he diversifies within each company by focusing on reinvestment and growth. Profits are often reinvested back into the business to expand operations or improve efficiency. This allows his portfolio to grow organically and reduces dependency on external factors for returns. 8. Emotional discipline. Another subtle aspect of Buffett's diversification is emotional control. By investing in well-understood, resilient businesses, he avoids panic selling during market dips. This emotional stability is a hidden form of diversification. It protects your capital by preventing rash decisions. 9. Examples from Buffett's portfolio. Coca-Cola, steady returns and global brand recognition. Apple, dominance in technology and recurring consumer revenue. Bank of America, exposure to financial services with strong management. Kraft Heinz, consumer staple products with consistent demand. This shows that intelligent diversification isn't random. It's a carefully curated set of businesses that complement each other in risk profile, industry, and growth potential. 10. Key takeaways for investors. Stick to what you understand. Focus on quality over quantity. Balance sectors but avoid over-diversification. Invest for the long term. Keep emotional stability as a risk management tool. Reinvest profits for growth within your portfolio. By following these principles, investors can replicate Buffett's approach on a smaller scale, building a portfolio that is both diversified and high-performing. Diversification, when done intelligently, is not just about reducing risk, it's about enhancing the potential for steady, compound growth over decades. Warren Buffett's approach to diversification is often misunderstood. Many investors think diversification means owning dozens or hundreds of stocks across random sectors. Buffett's strategy is different. He believes in focused diversification, owning fewer, carefully selected businesses that you truly understand while still spreading risk intelligently. 1. Concentrated investing versus over-diversification. Buffett's principle is clear: over-diversification can dilute returns. Instead of spreading investments thin across many unknown companies, he focuses on a handful of high-conviction stocks. For instance, his investments in Coca-Cola, Apple, and American Express form a concentrated portfolio that generates substantial returns over decades. Lesson: avoid owning stocks just to diversify. Each investment should have a clear rationale. Example: in the early 1990s, Buffett avoided tech stocks he didn't understand, focusing on businesses with stable cash flows. His concentrated approach protected his portfolio during the dot-com crash. 2. The role of moats in portfolio selection. Buffett emphasizes businesses with economic moats, or competitive advantages that protect profits from competitors. These can be brand strength. Coca-Cola's global brand allows consistent pricing power. Cost advantages. Companies with superior production efficiency or supply chain advantages. Network effects. Businesses like Apple benefit from loyal user ecosystems. Diversification, in Buffett's eyes, doesn't mean random stocks. It means a set of moat-protected companies across industries that reduce risk naturally. 3. Sector and industry spread. While concentrating on high-quality companies, Buffett ensures sector diversity to avoid systemic risks. Consumer goods. Coca-Cola, Kraft Heinz. Technology. Apple. Banking and finance. Bank of America, American Express. Insurance. Geico. This approach balances risk without overloading your portfolio with unrelated companies. Even if one sector suffers a downturn, other investments continue to grow. 4. Understanding correlations. Buffett analyzes how investments correlate. Investments in similar sectors or correlated markets increase risk, even if you hold multiple companies. His portfolio shows intentional selection of assets that react differently under market conditions, providing natural risk mitigation. Example: during the 2008 financial crisis, his investments in consumer staples and tech performed differently, cushioning overall portfolio volatility. 5. Long-term mindset as a diversification tool. Time is one of Buffett's most powerful diversification tools. By holding high-quality businesses for decades, he allows compound interest to work, reducing the impact of short-term market swings. Lesson: diversification is not just about spreading capital, it's also about spreading exposure over time. Example: Buffett's 50-year holding in Coca-Cola has grown immensely due to consistent reinvestment and patience. 6. Buffett's mistakes and lessons. Even Buffett has made errors in diversification. Early in his career, he bought companies outside his circle of competence. Overconcentration in a misunderstood investment can destroy wealth. The takeaway: focus, research, and knowledge are the ultimate diversification tools. 7. Risk management principles. Buffett defines risk differently than most. It's the permanent loss of capital, not volatility. He diversifies in a way that reduces the chance of permanent losses, while still allowing high upside. Example: Buffett avoided high-flying tech stocks without predictable earnings. Example: he invested heavily in Wells Fargo in the 1980s after thorough research, demonstrating calculated concentration. 8. Reinvestment and growth. Buffett's diversification also includes internal growth. Profits are reinvested to compound returns. Companies with strong cash flow can reinvest earnings to expand operations. This organic diversification reduces reliance on external investments for returns. 9. Psychological diversification. Buffett's approach also considers emotional risk. A concentrated, well-researched portfolio reduces panic selling. Investors with too many unknown positions often sell at the wrong time. Buffett mitigates this by investing in companies he fully understands, maintaining emotional discipline. 10. Practical steps for modern investors. Identify 5 to 10 companies you understand deeply. Check for economic moats and sustainable competitive advantages. Spread across 2 to 4 sectors to avoid systemic risk. Avoid over-diversification. More is not always better. Think long-term. Patience compounds growth. Reinvest profits intelligently. Avoid emotional decisions during market volatility. Conclusion: Buffett's approach to diversification is not random. It is a mix of concentration, sector balance, long-term focus, risk management, and emotional control. Investors seeking to replicate his strategy should prioritize understanding, patience, and disciplined selection. By following these principles, even a small investor can build a focused, intelligent, and resilient portfolio, harnessing the power of Buffett-style diversification without spreading resources too thin or taking unnecessary risks. Warren Buffett's philosophy on diversification is both simple and profound. It's not about owning as many stocks as possible, it's about understanding what you own, spreading intelligently, and protecting against permanent loss. In this section, we bring together everything we've learned and show exactly how to apply Buffett's rules in today's market. 1. The core principle: quality over quantity. Buffett consistently emphasizes quality investments over a large number of holdings. A portfolio with a few well-chosen, high-quality companies can outperform a widely diversified but mediocre portfolio. Actionable tip: focus on companies with predictable earnings, strong cash flows, and a durable competitive advantage. Avoid chasing stocks just to fill slots in a portfolio. 2. Combining concentration with safety. Buffett's genius lies in balancing concentrated investments with risk control. Pick 5 to 10 high-conviction companies you understand deeply. Spread them across different sectors to avoid total exposure to one market shock. Include businesses with resilient models that can survive economic downturns. This approach maximizes returns while controlling downside risk. 3. Sector diversification without dilution. While Buffett favors concentration, he also ensures strategic sector coverage. Consumer staples, consistent demand, technology, innovation and growth, finance, banking stability, insurance, recurring revenue and capital efficiency. Diversifying across sectors protects the portfolio from cyclical downturns without diluting focus. 4. Risk awareness. Permanent loss versus volatility. Buffett defines risk as the chance of losing principal, not short-term price movements. Avoid investments where you could lose capital permanently. Do not equate volatility with risk. Temporary price drops are irrelevant if fundamentals are strong. Example: Buffett held through market crashes, confident in his business's long-term value. 5. Emotional and psychological discipline. Investing is as much about mindset as it is about numbers. Buffett avoids the mistakes most investors make because he chooses companies he understands fully, holds positions patiently without panic selling, uses diversification as emotional protection, ensuring he won't be tempted to sell during market noise. This psychological edge is crucial for long-term portfolio success. 6. Leveraging compound growth. Diversification is enhanced by allowing returns to compound over time. Reinvest profits intelligently. Stick to long-term positions in high-quality companies. Use dividend reinvestment and earnings growth to expand exposure without over-diversifying. Buffett's wealth illustrates how compound growth magnifies returns in a concentrated yet balanced portfolio. 7. Lessons from Buffett's mistakes. Even Buffett has learned from mistakes. Buying outside his circle of competence resulted in poor outcomes. Overconcentration in unknown areas is risky. Lesson: knowledge and understanding are more important than sheer number of holdings. 8. Modern application. How you can follow Buffett. Research companies thoroughly. Limit holdings to a manageable number of high-quality investments. Ensure sector spread for risk mitigation. Avoid emotional decision-making. Stick to fundamentals. Reinvest profits strategically. Track long-term performance rather than daily price fluctuations. 9. Conclusion. Buffett's legacy in diversification. Warren Buffett teaches that intelligent, focused, and well-thought-out diversification is the key to long-term wealth. Investors should understand the businesses they invest in. Combine concentration with strategic spread. Focus on avoiding permanent loss, not minor market swings. Harness the power of compound growth. By applying these principles, you can build a resilient and high-performing portfolio, even if you're not a billionaire. Buffett's rules are timeless and universally applicable for any disciplined investor willing to focus, research, and remain patient.